How do the ultra wealthy pay almost zero taxes legally while getting richer every single year? Well, they don't sell their assets. They follow three simple steps. They buy assets, they borrow loans against those assets, and they die with all that debt, passing on the assets to their heirs. Today, I'm breaking down this famous strategy, also known as the buy, borrow, die strategy in plain English, so even a complete beginner can understand what's going on here. If you've ever wondered why billionaires like Elon Musk or Jeff Bezos can have billions on paper but pay less tax than the average teacher, well, this video is for you. So give this video a like, subscribe to the channel, and let's get into today's content. Now, for those of you that don't know who I am, hi, I'm Patrick. I've been an investor for over a decade, an option seller for about 7 years, and I've been investing in crypto for 7 years as well. I've grown my portfolio to over $250,000, and I run a little school community by the same name as this channel. If you want to go check that out, link is in the description below. So today we're talking about what is called the buy, borrow, die strategy. It's not illegal. It's not a hack in the shady sense. It's just using the tax code exactly how it was written, how it was meant to be used. Most of us get paid with ordinary income, salary, wages, bonuses, and the government taxes that money immediately, sometimes 30, 40, 50% gone before you even see your paycheck hit your bank account. Now, here's the key difference between someone like you and me who makes an income and how high status people make money. Billionaires and, centai and decamillionaires, they usually make it through assets that go up in value. Think Tesla stock, Amazon stock, real estate, crypto, index funds. If you never sell those assets, you have no taxable income. Your wealth grows, but on paper, you haven't initiated any taxable events yet. This is step one. You buy assets and give them time to appreciate in value tax-free. Typical assets include stocks, index funds, real estate, private businesses, and even fine arts and collectibles in some rare cases. Now, for this video, we will be solely focusing on stocks. Just to keep things simple, and stocks are a primary way anyways in which most wealthy people borrow money. So now you may be asking, how exactly do we borrow loans against our stocks? Well, step two is where the magic happens. Step two is borrowing against those assets instead of selling them. So let's say you had a $1 million S&P 500 ETF position like VOO. In most cases, if you sold this entire $1 million position, you would owe probably close to 33 to 50% in capital gains taxes, depending on your total income for the year and if you've had any other capital gains you may have made along the way. Now, that's potentially hundreds and hundreds of thousands of dollars gone to capital gains tax, going to the government, who will most likely waste it rather than staying in your pocket and benefiting you and your family for the risk you took to grow that golden egg. Now, instead of selling the stock and paying taxes, you can go to your investment broker like Questrade, Wealthsimple, Interactive Brokers, Robinhood, etc., or your bank and take out a loan against your stock. Now, most brokers and banks will offer to loan you money against 50 to 70% of the value of the stock, depending on the volatility of the stock, and at super low interest rates as well. Anywhere from 2 to 6% depending on how much you're willing to put up as collateral. Typically, the larger the stock position, the lower the interest rates these institutions will give you. So if we think about the S&P 500 stock, you have a $1 million position, your brokerage offers to loan you 50% of the stock's value. So up to $500,000 you can borrow against that position. And you can do whatever it is you please with this money. You can buy a house, you can buy a car, go for fancy vacations and dinners, or you can do what I do and invest that money to buy more stocks, more crypto, more cash flowing assets like income funds. And you may be asking, well, Patrick, how is this strategy sustainable? How do you not run out of money to borrow? Well, your assets are appreciating at a higher value than the cost of interest on your loan. So in a way, you are getting a cash loan against your stock position, paying an interest rate on that loan of, 2 to 6% per year, and your stock is appreciating faster than that interest rate on the loan. Meaning, you get money to spend that is not a taxable event because debt cannot be taxed based off of North American tax codes, and you still own your stock. And it is most likely appreciating in value of 10% or more per year. My favorite strategy is to buy Bitcoin ETFs like IBIT and borrow against approximately 20 to 30% of the loan in bear markets and deep bull market corrections in order to buy income funds like the covered call funds I talk about on this channel, or buy more shares of the same Bitcoin ETF. Now, why do I personally choose Bitcoin? Well, because its compounded annual growth rate is still very high, around a 40 to 50% cumulative annual growth rate. If we actually look at the past 10 years, it's closer to 59%. So I can stand to pay very high interest rates on these loans, and I'm still able to make a profit on the Bitcoin I borrowed against because of this high growth rate. In most cases, with traditional assets like the S&P 500 or global stock market funds like XEQT, you can borrow loans against these stocks and pay upwards of 8 to 10% interests on these loans and still have your stock outgrow the interest. Now, if you are using the money to buy more assets, that is. But if we take it one step further, if we do this with a Bitcoin ETF like IBIT, we can handle much higher interest rates like 25% and still make a profit. So that means technically, and I personally would not ever recommend this, but you could actually take an advance from a credit card, pay 20, 25, 30% annual interest and buy Bitcoin ETFs and still make money on it. So Bitcoin in a way gives you a much larger buffer and a much larger growth rate for this buy, borrow, die strategy. Now there is one caveat that you really have to pay attention to and monitor with this strategy. You cannot borrow the entire amount that the bank or brokerage is willing to lend you, because you can get margin called and your stock can be taken away from you if the stocks lose value past a certain point in a correction. We never know when a correction will come in assets, which is why I recommend to only take a fraction of what they're willing to give you, to leave room for error or for market corrections when they inevitably do happen. So in the case of an S&P 500 fund, I would be comfortable taking 50% of the loan the brokerage is willing to give me. So if they offered me up to $500,000 against my $1 million stock position, I wouldn't take out more than $250,000 if I'm using this money to reinvest into more assets. And if I'm using that money to live life and pay my bills so I don't have to work a day job, you follow the golden standard 4% rule, where you withdraw 3 to 4% of the $1 million stock position per year to live off of, which is like $30,000 to $40,000 on a $1 million position. And what about Bitcoin? I would be a lot more cautious with how much you borrow to reinvest, because it is a lot more volatile and can see 50, 60% drawdowns in bear markets, which would very easily wipe you out and margin call your stock position in the case of a bear market. So with assets like Bitcoin, if I had $1 million of a Bitcoin ETF like IBIT, the brokerage would probably offer around $500,000 to borrow against this stock, and I would not borrow more than like $150,000 if I were going to reinvest that money back into more assets. So about 30% of the loan value. And I would not take more than 10% per year of the stock's position value, so $1 million, if I were to use the loans to pay for life expenses. So with a $1 million IBIT position, take 10% of that, and I wouldn't take out more than $100,000 per year for living expenses. And another little tidbit I'll leave with you guys. If you borrow money against a stock and reinvest that money into more assets that appreciate and potentially pay out a dividend or offer consistent cash flow like income funds or real estate, you can sometimes, again, depending on the jurisdiction, write off the interest payments on the loan on your income tax return. So in a way, you can get a loan where the interest is tax deductible if the asset you're investing in has a cash flow, i.e. a dividend, and you now own more cash flowing assets while being able to write off the interests. And how do we finish this buy, borrow, die strategy cycle? Well, finally, step 3, you die. Yeah, it sounds morbid, but hear me out. When you die, depending on your tax jurisdiction, again, something incredible happens. Your heirs get what is called a step up in basis. That means that the original purchase price of your assets gets reset to the value the day you die. So all those unrealized gains you made, poof, they no longer exist. Your gains literally die with you, and your heirs own the stock or any other asset at the price you died with. So they have to pay zero capital gains for all the unrealized gains you accumulated over your lifetime. However, in some of these tax jurisdictions that allow step up in cost basis, the government can make your heirs pay back the loans taken against the stock that still exists. They can either keep it and keep paying the interest on the loans or wipe it from the value of the existing stock. Now, obviously, this is where you want to have an actual conversation with a lawyer and understand exactly how it works in your place of residence, because every country, every state, every province can have different caveats and exceptions to these rules in their tax code. So this is very important to remember. So now you may be asking, who is this for and who is it not for? Well, number one, you need assets that consistently go up in value, like the S&P 500 or a global stock market index like XEQT or Bitcoin. The higher the average return, the more you can borrow. The more conservative the growth, the less you can borrow. Very simple. Number two, you need enough wealth that banks will give you huge loans at low interest rates. The larger the loan, the lower the rate they can offer you. And number three, the ability to contain the interest payments even in bad years, meaning you have the margin to compensate for bear markets where your assets lose value. Because remember, if you borrow too much money against your stocks and the stocks go below the required value needed to keep that loan, you will get margin called and the institution will take your stock away from you. And finally, number four, the most important deciding factor, a very long time horizon, 2-3 decades at minimum. You need to give your assets time to appreciate and time to be on the right side of the investment for this to work. This is not a short-term thing. This is a lifelong endeavor. So for this strategy to work smoothly, you need a time horizon of 20 to 30 years for your investments, because the longer the time horizon, the more likely you are to have your assets appreciate consistently over time, giving you a solid foundation of data and numbers to work with. So that is the buy, borrow, die strategy in plain English. It's not evil, it's not cheating, it's definitely legal, and it's literally how the tax code was written. Governments use the tax code against its citizens every day to extract as much profit and taxes as humanly possible. So you may as well use the same tax code to benefit you and your heirs, and pay as little taxes as the legality of the tax code allows. I will continue to borrow money until I die, as long as the arbitrage is still worth it. Now, did you already know about the buy, borrow, die strategy, or did you just learn this and it helped open your mind to the possibilities that exist? Let me know in the comments down below. Now remember, you can use the tax code of your jurisdiction to help you, but if you don't, it will work against you over time. Don't be the person who treads water their whole life and just makes money to give it all back to the government in income taxes and capital gains. It's time you start thinking like an elite entrepreneur, not a state pensioner. Money is debt. You have to change your mindset to how you approach money, because money devalues over time. The goal in life is to own assets, not cash, because cash does nothing for you, whereas assets will work for you until the day you die, and then some. Now, if you stuck around this long, go ahead and catch another one of my videos right over here, or check out my channel over here, where you can take a look at all the other content I have to offer about investing in my personal investing journey. That's all for me today. I'm Patrick with Apex Wealth Collective. Take care, and I'll see you guys in the next video.